Welcome, everyone. My name is Paul Graham, and we're going to go through today investing in oil and gas. Oil and gas is a fascinating diversification, tax strategy, and cash flow leveraged income asset that you, as an investor, should consider. Today, I'm joined by Michael Tanner. Michael, welcome.
Thanks. This is exciting. There's nothing more I love than talking about oil and gas. So let's do
Nothing
this.
more. Yes. So I invited Michael today for a number of reasons. One, his background. So undergraduate at School of Mines, doing petroleum engineering, master's in economics, has been in the finance and even a junior developer, as he might call in the technology world. Really just to say for his career, he's been in the energy space in all these different facets, right? Technology, finance, just overall like operations in these mid-scale type companies to have an understanding of how these companies are growing, changing, thinking. Now, why that matters is because this is not the BP and Exxons of the world, and that's okay, because as an investor you are investing in these type of middle companies, right? Mike, is that fair to say?
Yeah, absolutely. I mean, everyone hears about Exxon, Chevron, and BP. They actually only produce about 10 to 20% of the overall oil and gas in this country. Yes, it's a big number, but the majority of the oil that's actually produced in this country is by your mid to small and really mom and pop shops. There are thousands and thousands of oil and gas companies that do 100, 200 barrels a day. It's a far cry from what Exxon's doing, but in the aggregate, when you add them all up, it's actually a much larger share of the overall oil and gas production. And the beautiful part about investing in this oil and gas is you can bypass the stock market and go directly into these small oil and gas companies and truly, as we'll talk about, gain massive tax advantages, achieve a really great monthly passive income, and really, and I think what we'll talk about is diversify your portfolio and really gain some extra leverage in the market.
Yeah, certainly. That being said, I want to take a moment to briefly talk about the difference between stocks, right, in oil, options in oil, and then actually investing in oil and gas. There's probably some nuances there. We'll get into the nuances and the nitty gritty, but I just want to first address this because I have some energy shares. I'm investing in oil and gas, right? Also, I would say that's not fully the case, right? Like I'm on the surface level of the integral part, and there's certainly all these differences, with that. And so if I, as just like a novice new, middle school kid who just bought some Chevron stock or something, right? Or maybe that seasoned professional who's just had it in their portfolio or something of the sort, like educate, inform me, tell me, am I really investing in oil and gas? Like, what is it really doing for me? Is it doing anything for me? Like, what have you found? Because you've also done some investing too, right?
Oh, absolutely.
I wanted to have you highlight that.
I would be a fool if I wasn't taking my own advice. So there's a couple different ways you can invest when I call in the energy business. So one, you
Right.
obviously have stocks and your equities market. And that's obviously the easiest way. It's probably the most decoupled from the actual whims of the energy markets because now you're dealing with things other than the underlying oil and gas metrics. You're talking about balance sheets, you're talking about debt loads, you're having to worry about if it's going to be a good or bad earnings report. And that
Mhm.
earnings report may or may not necessarily be tied to how much oil they're producing. It's got more to do with some of the macro environments around that. And so that is what I kind of call not a surface level, but it's one avenue. If you really, really like the stock market, you can obviously invest in oil and gas companies there. But there are more levels deep than this. Kind of the second level down from that is your traditional oil and gas syndication. And, I'm sure most people listening to this are real estate investors or have considered investing in real estate. It acts no differently than your traditional real estate syndication. An oil and gas company creates a PPM, opens up a fund, says we're going to go do X, Y, and Z. We need $100 million. They go out and find individual retail investors to invest 100, 200, 300, 500 grand, however much said be, fill up that PPM, fill up that fund, and then go ahead and execute upon that plan. And that is your traditional, it's a management fee on top of that. Think your classic 2 and 20 model. What I like to tell people is oil and gas is a capital intensive investment. And so don't be shocked if you look at the fees and are a little bit like, what? And I always tell people, if you're looking at investing in an oil and gas syndication, watch out and really look at what the fee structure is, because it's going to be different than what you see in real estate. And we can dive into a little bit of that later, but that's kind of the syndication route, very similar to what you'd see in real estate, just designed for oil and gas. And then there's the third route. And this is the route that I'm biased to. I kind of call it the level below both equities and syndication. And that's what I call direct working interest. That is where you go straight to the source, you go straight to the well, and you find an operator, and there are a bunch of these operators out there, and you actually physically buy a percentage of the well. In the business, we call it working interest. You can theoretically think of it as you are buying a percentage of the well, meaning you're entitled to that exact percentage of the oil and gas that comes out of the ground.
Okay.
You're also liable for the expenses relative to your proportional share. Now, what most operators in this situation will do is net you out. They'll say you made $10,000 of income this month. It cost us $3,500 to get that oil. Here's a net check of $6,500. So they will net you out that way. So you're not necessarily getting a bill at the end of the month, how sometimes it traditionally works. If you're an oil and gas operator selling working interest to another oil and gas operator, they'll send you gross revenue check. They'll also send you what's called a joint interest billing statement, or a JIB, which is basically just a bill for all your expenses. They'll net you out so you get one net revenue every month, but it's really going directly to the source. And you can think about equities are a little bit tied to the underlying profitability or success of, say, of individual oil and gas company or the individual oil production. As you move into a syndication, you're getting a little bit closer to the source. There, you're now not worried about the valuation of the debt markets and how what's going on in China is affecting, because this fund is just investing in specific oil and gas projects. Now, those projects might be a little bit less tied to the underlying physical reality of the business, but they're going to be much more tied to it than the equities market. You invest directly in a well, it don't matter what happens in China, it doesn't matter what happens in Russia. All that matters is how much oil am I producing, what price is it, and how cost effective is the operator getting it out. And those are the only three questions you have to worry about. And I think that's a much better route for an average investor, specifically one who doesn't know much about the oil and gas business, but wants to expose their portfolio to oil and gas, because it simplifies the number of questions that they need to ask.
Yeah, you bet. And it is eerily similar to real estate. One thing I want to ask you, I believe you mentioned something like you call it like 2 and 20 or something like that. Did you say something like that, or recall what that is, or can define that?
Yeah. So 2 and 20 is what I call the fee structure. So, if you've invested in an oil in a real estate syndication, there's some sort of fee structure on that. And when you hear 2 and 20, it really stands for 2% management fee and 20% carried interest. So management fee is generally a one-time management fee. Now, some companies like to be tricky and call it assets under management, which means they can take that fee every single year, which personally I think is tricky, because you've deployed all the capital. Where's that money coming from? But let's just talk about your, a one-time 2% management fee. So let's make a nice whole round number, $100 million. On $100 million, a 2% management fee works out to $2 million. And the 20% carried interest means, let's say $5 million, or let's say $10 million comes back and is available for dividends every single year. 2 million of that is going to go to the sponsor, and 8 million is going to get shipped out in terms of actual dividends. So understanding the fee structure, if you are interested in an oil and gas syndication, is critical, mainly because of the capital intensive nature of it. In real estate, and this is where you, being the real estate expert, Paul, you can correct me. I know I always use these analogies that may or may not be true, but the amount of what I call labor and expenses that goes into standing up an oil and gas project far exceeds real estate. You need engineers. They're not cheap. You need third-party contractors. Trust me, people in the oil and gas business on the labor side, they're well paid. And so generally what you see from a fee structure is a much higher one-time management fee and generally a 20 to 30% carried interest, which relative to, say, like what a traditional private equity company charges, which is a standard 2 and 20, can seem outrageous. And so it's imperative as an investor to understand what's the fee structure, because the higher the fees are, the longer it's going to take for you as an LP to get your money back. And if the fees are so high, how are you even going to get your money back? You know, it's if you give me $100 and I charge 100% management fee, it's going to take a while for you to get your money back because I don't have any money left over to invest. So it's imperative to kind of understand what that structure is. And it's the first question you should always ask your sponsors, what's your fee structure?
Yeah, for sure. Yeah, and that's definitely the case with real estate. I want to take a moment just to share a little bit about my background so people also know where I come from in my context too. So I'm a former commercial real estate broker, investment sales, and portfolio office leasing. Went into actually software, became a co-founder, and then really just continued my career in technology for about 7 years. Really, that's then, brought today where it's taking the concept of, capital markets, financial, understanding, and really the intelligence of behind it to then combine this idea of connecting people, with capital together for investors to benefit, right? So as we think about oil and gas, and something that both Michael and I have raised for is, how do we not only educate of what is the industry, what is the asset itself, but also inform of, like, to your point, exactly the questions that we should ask in this process. Because I'm of the belief that everyone, when they start investing in real estate, tends to do single family, rightfully so. Then it goes to multifamily because they once lived in an apartment, and there's also more multifamily assets in comparison to other commercial assets. So again, makes sense. And then it kind of, dissipates across the board, right? So this is also a fascinating conversation because it's also diversification beyond what you traditionally have at meetups when you go to real estate or investor type pieces, right? So there's a number of different nuances here that not only want to educate on, hey, it exists, this is how and why it exists, but then also, what are the different types? And then when you know and understand your risk tolerance, your buy box, things of that nature, you then can figure out, what questions to ask to see if this type of investment within oil and gas is also aligned with you, and, potentially make that investment. It's a big thing, for me, is to do that because, I've heard conversations of people being super excited or curious in investing in oil and gas, but really they're just investing what I at least call poke a hole in the ground, right? Which is, what's the formal term of poke a hole in the ground?
Wildcatting.
Yeah. Okay. So not poke a hole in the ground, but it's to say that not all is the same. And I also want to call this out from a real estate standpoint. A single family home is a single family home is a single family home, right? Same thing with multi, right? Same thing with self-storage, being that the asset is what it is. Now, when you go into things like industrial, you then have some of those slight nuances that are a little bit more different power requirements, things like that. You do have that a little bit in the multifamily space, right? If they're garden level apartments or all, different units, things or different sections of units, right? Not just a single unit, but those nuances aren't necessarily going to be a completely different type of investment than, say, the oil and gas type things, right? A vertical well is very different than a horizontal well, and we'll go through some of those pieces, but really just wanted to call out that there are some differences here, and it's really important for the education, which is really why we're here and why we're doing this. We're first going to talk about the different sort of value points of oil and gas. And so from a 0 to 10 scale, just again to kind of conceptualize and compare to real estate and have a good sense, it's our best analysis and understanding that from a cash flow standpoint, oil and gas is at a 7 to 8 kind of on the scale of this investment piece. Mike, do you want to give any insight in terms of why you not only think but also feel from the cash flow side it is relatively high of sorts to the 10?
Well, because oil and gas, you're producing it every month. There's monthly dividends. Oil is producing Monday, Wednesday, Friday, Saturday, Sunday, rain, sunshine. It's always producing. So unlike if you talk about real estate, someone might leave your apartment complex. You may not have your single family home rented. You're always assuming you're investing in a project that has oil production, which there's a question to ask there when we get into the different asset classes. But let's just assume, hey, I'm investing in an oil and gas project that produces. That oil is going to continue to produce, and you're going to have that for 15, 20, 30 years. So your time horizon is great. The industry is set up to deliver monthly dividends, which I think is a little bit different than the real estate business, where I think it's sometimes a lot of quarterly, or, the dividends
Dependent, yeah.
are maybe a little bit more spotty. The business is set up to run revenue every month, to distribute revenue every month. So from a cash flow perspective, why I would put it so high is mainly because it's the dividends are there, and they're coming to you on a regular, frequent basis, which is critical. Because if you invest in a project, especially a non-liquid project like a real estate project, or something that's not necessarily, that you don't necessarily have the ability to pull your money out, it's like any kind of private investment. Getting that monthly cash flow gets you closer to providing that liquidity event than, say, something else would.
Yeah, certainly. And it reminds me in a comparison of sorts. If you have a multifamily property, you wouldn't and really couldn't, depending on, the term, sure, from like a short term or maybe a midterm rental standpoint, but ask a tenant to leave because someone else came to your door and said, hey, I'd be willing to pay you more. Hey, can you leave for 2 weeks and then come back and then continue at your rate? There's someone who wants to come in for 2 weeks and pay like a higher rate, right? Like those sort of levers don't formally exist within real estate, or truthfully, I just believe you're making it incredibly complicated, right? Like, why would someone come back and stay? Like all these different nuances. But it's just a comparison to say, with oil and gas, you have that ability to have those levers as an operator, right? If you are seeing that the market is, say, slowing down or speeding up, or, consumption, demand, supply, like these different, again, levers, you then as the operator are then going to operationalize your rig, essentially, right? Operations, to then have the best and highest output, right? Mike, anything to kind of add there on how operators are, optimizing the market really as supply and demand might change?
Yeah, I think it depends. Again, if you're going into syndication, it's all about, is your sponsors, your sponsor is also generally the operator. And the real question is that operator efficient? If you're directly investing in an oil and gas project, well, again, knowing who the operator is, it does change. It does vary widely. Now, what I would say is, if you're investing in a company that is going to outsource the operations, I'd be wary of that, if only because there's now a third level. You're now one level removed again from the actual operations. And that there becomes a misalignment of incentives when the operator isn't necessarily participating in the revenue of the well. So the big thing to do is hire a contract operator. Well, that contract operator is just getting paid a fee to manage the wells. They don't necessarily care if the well's producing the maximum amount it could. They don't necessarily care that it's as efficient as possible. Maybe it doesn't need a new pump, but it would be cool if it had a new pump. So they go ahead and order a new pump. Well, that gets charged to you, the working interest owner. So understanding how the incentives are aligned from a GP to an LP to who's the actual operator of it, I think is critical and one of the most important questions to ask.
Yeah, absolutely. I mean, same thing in real estate as well, right? People are delegating that out and you don't have insight to that then increases exposure for your investment, and that uncertainty then, draws risk. The next piece is, exit value. So in exit value, we think of, the equity that's, really created. We put it as kind of a 4 or 5, lower on the scale. Talk to us a little bit about, why that is.
Well, I think this number could range. We could put it at a 4. We could have also put it at a 10. The reason why I like to lower it on your 1 to 10 scale is mainly because oil and gas exits occur at the huge level. I mean, when you hear M&A deals, think billion-dollar companies. You, as a specific investor, are probably not being able to get access into these large private companies. Maybe you can if you're investing through a private equity vehicle or whatever. But if you've got, $500,000 that you're looking to allocate into the oil and gas space, and you go the direct working interest route, which is my preference, the company you're investing in is maybe a 10, 20, $30 million quote unquote market cap value or enterprise value. Well, that company, the sale process isn't going to just be someone's going to snatch them up. It's going to be selling for not parts, but selling pieces, selling certain things. So what I always tell people is, if you're investing directly in oil and gas, and part of their valuation metrics for, hey, you're going to get a 3x return, if part of that is based on a potential exit, be wary, because the exits, especially at the smaller scales, are hard to control. There's the buyer pool for $10 to $30 million companies are there, but they're small. And anyone who's telling you, I know that we're going to be able to sell this asset in 3 to 5 years is being a little bit disingenuous, in my opinion, from the standpoint of they don't really know that. And a lot of times what they're doing is they're using the exit value to raise their return metrics. So that's why from a underwriting perspective, when we work with, when we underwrite deals here at Sandstone, we always look for and weed out projects that have majority of the returns baked into the exit, because there's way more risk associated with that. If in 3 to 5 years you can get all your money back just based on the dividends, that's a huge plus. It's one of the reasons why the cash flow is that 7 to 8 range. And I move the exit value down to that 4 to 5 range, if only because, yes, you might, there will be an exit at some point. You're not going to be in the project forever, but it's less, the waters are a lot murky on that at the level at which the direct and syndication space takes. So it's one of the things we just tell people, watch out for operators that claim huge exit values and really quiz them on, well, how do you know that? And what you'll find is a lot of them don't. They're using it to inflate their valuation metrics.
Yeah. Tell us more about who Sandstone is.
So we are a oil and gas asset management company. We've helped multiple private small operators raise capital, as Paul said. He works on kind of the connection of capital to these operators. I work on the underwriting and finance side, so working with these operators to make sure they're properly underwriting their deals, and then working with them through the life of the project to make sure that they're meeting their requirements to their LPs. And I think that's the critical part is, we see these projects through the life of the site, of the life of the project, or what we would call full cycle. We don't just necessarily place the capital and then go about our merry way. No, we want to make sure that the capital that we place, it actually performs. We have a great track record. We have a great track record of working with numerous operators to make sure that takes place. And it's really fun. It really kind of combines both we love. As you can tell, I could sit here and talk about oil and gas investing for hours and the different nuances of it. I'd love to talk with you specifically about it. I'm sure there'll be some link in the description below. If you have a deal you need evaluated, please let me know. If you also just want to get on a call and talk generic oil and gas investments, you can go ahead and just reach out to me personally. I'm happy to talk to anybody. But no, so we've had tremendous success doing this. We're actually really looking forward to rolling out some new products ourselves, but that's kind of a little bit about what we do.
Cool. Yeah. Thanks for sharing. Next is tax. So on a 0 to 10 scale, where does tax stand?
Is there higher than 10? Can we go 12? Can we go 15? This is where I think oil and gas blows away any other alternative investment because of the massive tax benefits. And I say this up front. I'm not a CPA. Paul's not a CPA. Consult your tax attorney, CPA, before you just take my advice. That all being said, oil and gas provides tremendous tax benefits via the tax code. So when you invest in an oil and gas project, 9 times out of 10, they're going to go take that money and drill a well. Maybe they're, as Paul would say, poking a hole in the ground or wildcatting, or maybe they're drilling a development field where there's all these wells around it, and we're just going to go drill what's known as an infill well where we feel very confident there is oil. Okay? All of the money that goes into the ground, tangible, intangible completion and intangible drilling costs are 100% tax deductible from ordinary or investment income. And that's critical, not just investment income, but ordinary income. It's why net worth individuals love investing in oil and gas because of those tax benefits. And generally, if you're investing in an oil and gas syndication, you see somewhere between 70 to 80% of your total investment being able to be written off at the end of the year, if only because not quite all of the money's gone into the ground. There's been some fees. There's probably been some land work. There's been a little bit of, employees got to get paid. So it all hasn't necessarily gone into the ground. If you invest directly in an oil and gas project, that number can even get up to 80, 90. I've seen 95. I've seen 100% before, because every single dollar has gone back into the ground. So if you have a tax problem, oil and gas is a tremendous way to get a tax deduction and then also go back to, again, this is a cash flow product. So you're talking about a 7 to 8 on the cash flow scale and a 15 on the tax scale. So that's one of the the big benefits that high net worth individuals have seen. Or if or from a 1031 exchange standpoint, yes, you can 1031 exchange from real estate into oil and gas. You can do it. So it's one of the reasons why oil and gas has become huge in the space, is because the tax benefits are tremendous. As always, consult with your CPA.
Yeah, certainly. The one thing I want to highlight with this is the Tax Cuts and Job Act that was enacted in 2018, right? And the first year of bonus depreciation, this for real estate, right, was up to 100%. And the depreciation schedule has then, or will change, over time. So what that means. So between the end of 2022 and before the start of 2024, it's 80%. Then next year, it's 60%, 40%. And then between December 31st of 2025 and after December 31st, 2025 and before January 1st, 2027, bonus depreciation for real estate will go down to 20%. Now, that is, also thinking through why cost segregation studies have become, popular. I'm not sure if it's become more or less or what the change in cost segregation studies have been, but I would think with reasonable understanding that they have increased. You still have the same, issues and conversations and pieces that real estate is, right? Tenants and toilets and a number of those things. So in comparison, if you're looking for tax savings, this is, again, the best way to have the most amount of depreciation offsetting your high income to then have clear and clean cash flow, of which tends to be, and oftentimes is, more than real estate, and diversification, and completely hands off. To my understanding, Mike, you just, check your mailbox, or how does this work?
Well, yes, it is a little bit, the classic idea of tenants, toilet. What is the phrase? Tenants, toilets, and
I've heard some people say like termites as well. I mean, really, it's just a challenge. And with short-term rentals, it's really just keeping your hair, right? Like that. That's what it is.
So there's none of that in oil and gas. It's truly a passive investment from the standpoint of the operator's never going to call you up and say, hey, we need you to come swing a wrench. They're never going to call you up and say, hey, we need you to go kill this snake on the lease. It's truly a passive investment. So assuming you invest in a good project, you've done your underwriting correctly, or work with somebody like us to make sure the underwriting has been done correctly, it is truly a passive investment, which is why, again, investors really like it, because it is just mailbox money.
Yeah, certainly. If you're wanting to learn more about specific opportunities to invest in oil and gas, head over to investorsguidetojoy.com/invest to learn about specific projects available for you. All right, let's talk about the accreditation status. So for those who aren't familiar, there's 506B, 506C. There's also sophisticated investors. Now, there's a number of different tests and certifications that you could basically take to become accredited. And I'll leave that out because that's a very small amount of the population. But 506B, that is for a non-accredited investor who does not have a $200,000 income stream if they're single, or $300,000 if they are married. They also do not have a $1 million plus net worth, excluding their primary residence. And so why those things matter is because 506B and 506Cs can be offered differently. If you are accredited, you can then be publicly solicited to, meaning, ads, or even people sharing it on, Facebook if they're a GP, or even within that meetup group that you occasionally go to at that Mexican restaurant. So ultimately, it is to say that your deal flow and your ability to invest in these types of assets can sometimes be challenged. That sometimes can mean it can be a good old boy club type of analogy, right? Where you have to know the right person with the opportunity. It's also to say you need to continue to do your evaluation with the right operator as well. Again, like we mentioned earlier. So Michael, when we think about this, like what are the types of, investors who can invest in oil and gas?
Yeah. So generally what you see syndications, they're either 506B or 506C. And that obviously goes accredited versus non-accredited. If you're a 506B, you can't advertise, you have to have a relationship. If you're a 506C, you can market, but you must be an accredited investor. There is this small little sliver that's called a sophisticated investor, where the direct working interest sits, which basically it's not Reg D, covered by the SEC, but it basically says I have the capital. You basically sign a subscription document that says I'm a sophisticated investor. I've done this before. I do have the significant capital. I understand that there's lack of liquidity. I understand there's all this stuff. So it basically is for people who have done that before. And it behooves you to make sure you are sophisticated if you are going into an oil and gas, specifically direct working interest investment, because you want to know. You're going to need to know. So from that standpoint, there is a little bit of leeway, but generally what you see is the accredited versus is not accredited. Accredited is, $1 million net worth or $250,000 a year W-2 income in back-to-back years, or I think 300,000 if you're joint filing with your partner. So I think there's a few different avenues there, but it's critical to also figure out what project you are investing in and where it falls in.
Yeah, certainly. Yeah. So the income for an individual is 200,000. And the concept is to say that it's each in the two prior years. So $200,000 of income each of the two prior years, and reasonably expects to have the same for the current year, right? As I mentioned, there's a number of different professional criteria that you can do with Series 7, 65, 82, and some nuances if it's a family client or of a family office that qualifies as a credit investor can also be, but not to complicate it, just as a single individual or as a married couple, those are the current requirements at this very moment. As we think about investing, because this is something that we're excited about, we're interested in for all the different advantages that we shared, what are the different investment types? So let's go first through a syndication. What are the different types of opportunities that I could invest in?
So there's a few different things. You've got syndications, you've got traditional direct working interest funds. Can we ask that question again? Sorry, I forgot what you were asking.
Yeah, so it's to say within the different investment types, within the different investment types, there's two main categorizations: syndications and direct working interest. Let's first go through syndications and what those deals and opportunities look like and what an investor would kind of see with them.
Yeah. So generally in a syndication, it's a grouping of different projects. So generally we're going to go do a little bit of work in North Texas. We're going to go do a little bit of work in South Texas. We may go do some stuff in Oklahoma, but it's a grouping of multiple asset classes. And generally they're somewhere between 25 and $100 million. Let's just say they can get bigger, they can get smaller, but generally if you're going to do a traditional syndication style where there's a sponsor and an operator, it's going to be a much, much, much larger fund size. And, it's probably a mix of things. There's probably some current production or, that they're purchasing. There's probably some poke a hole in the ground. There's probably some, what I would call not working interest investments that they're doing. So there's a variety of different ways per se that a syndication go about it, but think of it as it's a group of assets going under one roof. A direct working interest project is much more specific to a specific 4-well drilling program or a specific, I'm going to go buy 3 to 5% of this oil and gas field that's already producing or something along that sort. And so what that means is the underwriting requirements are a little bit different. You got to make sure that the project's good versus, in a syndication, you're really asking, is this sponsor good, versus, whether or not the operator in a direct working interest is good or not. There has some to do with it, but also has to do with, are these assets even worth it? And then, but they're generally a little bit smaller. They're generally the $1 to $5 to $10 million raises for direct projects because, they're usually kind of smaller chunks. They're usually vertical wells. We can maybe, in a later video, get into some of the nuances of that. I know we're trying to stick to investments here, but the style in which they go about actually, creating new oil and gas production can vary slightly. It's generally on the more risk less side when it comes to a direct project, and in the syndication where because of the size of the fund, they generally tend to take a little bit more risk because they feel like they have a little bit of excess capital to be able to cover up that risk. I've seen it work both ways. So point of the matter is it's usually a smaller size and you're usually getting access again to a direct project, where in a syndication, a lot of the times they're saying, we're going to go do X, Y, and Z. But if we get halfway through Y and we don't like it, we reserve the right to go do something else. Where in direct working interest, kind of come hell or high water, they're going to do what they say. And that can either be a good thing, or if the project's not great, it can be a bad thing. So there's pros and cons to everything. And I think that's the key when you read our ebook, is we kind of break down a lot of the different pros and cons of all this stuff. You'll kind of see, okay, that makes sense.
Yeah, certainly. To give a quick, just like insight, like vertical and horizontal wells, not in the, detail of petroleum engineering background you have, but just in terms of like an investor, like, are there benefits, concerns with it? Is there one that's like most similar to real estate for how it operates in terms of cash flow and predictability?
Yeah, so I think from a syndication standpoint, there's a little bit less window into what that looks like, just because of the mix of assets may or may not be known by the investor or the company. A direct project probably has more line of sight to cash flow. Now, that assumes that the project is good. So again, it just comes down to the whether or not the project is good versus the capital allocator and the syndication is good. And I think it's just the mix of questions you have to ask depending on which one you're looking at.
So for a syndication, like would they disclose and share whether they would do horizontal or vertical?
They, in my opinion, they should. They don't always do that because
Sure.
a lot of times what a syndication wants to do is reserve the right to go out and find I'm using quotes for everybody listening, the best project. Now,
Sure.
best is subjective to whatever that sponsor thinks. And again, the question you have to be asking if you're investing in a syndication is, do I trust the people allocating the capital? What's their track record? Have they done this successfully before? And if they haven't, that should tell you, well, how do I know they're going to be able to do it now? Whereas in a direct working interest project, it's more along the lines of, do I like this project?
Yeah. Okay. Yeah, it's great to know and to think about, as well as just overall, consider. What are, some kind of questions that would be, beneficial for individuals to ask? Certainly we've separated the difference between syndication and direct, right? Some of those questions will, kind of be answered, but just from a, hey, I only get to ask maybe 5 questions to a sponsor. Like, what would you outline those 5 questions be as an astute investor?
A sponsor history or general partner history, obviously, especially if you're looking at a syndication. That's the first question I would want to know is, what's their history, and is it successful? Is it not? If it wasn't successful, why? Doesn't necessarily mean they can't be successful in the future, but figuring out why. I think the next thing to ask is, what product are they targeting? You have oil, but you also have gas. We've talked a lot about oil because that generally is where a lot of the money made, but there are companies that go out and want to drill gas wells, but the arbitrage right now between oil and gas is fairly large. And I think understanding exactly what product they're targeting is critical. I think the next is, hey, where are these assets located? And especially if you're in a syndication and you ask them where the asset's located and they can't tell you a direct answer, again, that tells you that, oh, I need to be wary of this. I think the next is horizontal versus vertical wells. The nuance there is a horizontal well is way more expensive. It could produce a lot more oil and gas, but it's generally a little bit more risky. A vertical well is going to cost a lot less. There's going to be some other things around it. So obviously knowing what type of projects they're going to invest in is critical. And then obviously ask them about the tax benefits. If they're not being upfront with the tax benefits, that tells you that they may or may not be investing in drilling projects that actually get you the tax benefits. And that's critical. If you need the tax benefits, you need to find a product that offers those tax benefits, because remember, it's drilling new oil and gas wells that get you the tax benefits. It's not necessarily just buying oil and gas current production, which can be good, but it doesn't necessarily provide those IDCs and that are needed to obtain tax benefits. So understanding that is critical.
You bet. Yeah, that's absolutely imperative. And again, like a nuance that you might, or could experience, buyer's remorse in the sense of not asking that question if you are doing it for, the tax benefits, not being aware of that nuance. In addition to, what we've outlined here, what are some other things that we should be aware of, as we think of what oil and gas has done, right? We've seen it, change over time. There's now competition with electric and battery powered cars and that sort of aspect. And there's this idea that oil and gas is like going away, right? So conceptually, what are your personal thoughts on it? And then also, what are you seeing like in the industry as we think about a like 1 year, 3 year, and like off into the, 2100 type distance?
So, I mean, I don't think it's going to become a shock to anybody listening, but my opinion is oil and gas is going to be around for 50, 100 years, if not longer. I think we're so far away from being able to replace fossil fuels in the current energy mix that, renewables won't necessarily be able to catch up with that unless things drastically change. Obviously, there's black swan events that happen, but at the current pace we're at, we will never be able to replace fossil fuels as a primary energy source. So I don't see oil and gas going away at all. I only seeing it become more important to the energy mix. From a volatility standpoint, I never make a price prediction, because if I knew where prices were going, we wouldn't need to be on this webinar. We'd probably be with Richard Branson hanging out on Necker Island. So, if you want to know my opinion on where prices are going, could go up, they could go down, and that doesn't help anybody. It's why when we underwrite these projects, we underwrite them at multiple different price levels to make sure that even at some of the lowest levels, these projects still make sense and still can return capital to their investors. As far as where I see the industry going, I see a shift. Right now, everyone's drilling horizontal wells, and what we've seen recently is the vertical wells have become a much bigger part of the game, if only because the risk tolerance is much lower, especially for the retail investor who may not be in oil and gas. We've worked with a couple different companies right now who have had massive success actually drilling vertical wells and being able to return capital. It may not be as sexy as what Exxon's doing and drilling 4 mile long horizontal wells, but what is sexy is getting cash flow and getting your money back quickly so that you can then go around and invest more and have and continue to achieve that liquidity that you really want. So that's what I think in the short term. I think you're going to see a reversion a little bit from specifically on the smaller company side from horizontals to verticals. I think on a 3-year time frame, what you're going to see is a much more ubiquitous oil and gas space where you've got the concentration of the big super majors who have kind of gobbled up all the other big ones. And then you're going to continue to see that bifurcation of the smaller companies. I think you're going to see have a lot more access to these to invest in these smaller companies, if only because there's going to become more and more of them as the big boys continue to gobble each other up. And then in 5 years, I would say, it's going to be what you're going to see is energy become a security issue. I mean, right now it's just kind of becoming a topic that people are talking about, but energy security is critical. And I think specifically we talked about the difference between oil and natural gas a little bit and how to know and how to make sure your sponsor is asking you. But I do see natural gas becoming a huge part of the energy mix in the future because it's going to be a security. I mean, right now, natural gas generating the majority of the electricity in this country. Electricity, as we continue to increase the demand for it, is only going to become more important, meaning we're going to need to continually get more natural gas. Everyone's talking about the new LNG export facilities. And I think natural gas within the next 5 years will make a big comeback in the United States because of that.
Yeah, awesome. What are some things that we maybe didn't discuss that you feel would be beneficial to add to this conversation?
Well, I think really from an underwriting standpoint, I'd highly recommend, I think in the description below, we'll have this. I would go check out one of the deal evaluation series that I've done where you can actually see a full deal evaluation start to finish, and you can get an idea of how us at Sandstone, how we think about evaluating deals, because that's critical. If you're going to invest with us, if you're going to invest with one of our partners, you need to make sure that we underwrite these deals correctly. And especially if you're not in the oil and gas space, you need to rely on somebody to make sure that they're asking the right questions. And so understanding and getting a taste of how we underwrite deals, I think is critical. It's why we put all that stuff out there so that you can just see it and evaluate it for yourself and not just take our word for it. So I'd highly recommend checking out our deal evaluation project. I'm also more than welcome if you have an oil and gas deal that somebody's trying to pitch you, book some time on my calendar, send me the deck. I'm happy to just spend an hour with you on the phone, breaking it all down, giving you my thoughts. I'm happy to give you a recommendation. At the end of the day, you get to make the decision, but making that decision and figuring out what questions to ask is what we do really good. We talk to investors all the time about different deals, whether or not they should invest in it, whether or not they should get into deals that we have. So highly recommend looking at those two things. And then also, if you're interested, we have a link. If you're interested in some of the projects that we have a little form that you can hit, and we'll happily send you some executive summaries. You can take a look at it. And I would just love to get on the phone with any one of you and to talk more about this. As you can do, I can talk about this stuff all day and twice on Sunday. So don't feel like you're bothering me. And yeah, Paul, really appreciate you bringing me on and us talking about this.
Yeah, absolutely. So oil and gas is exciting to me because it's just a different topic and experience than, at least what I've been in initially with, SaaS and then also with real estate, and provide some interesting conversations. But as we mentioned, there's a number of different similarities to these things. And, was at one point concerned about, the news having like an impact on like oil and gas, but I was rest assured to know, like, especially as these smaller operators that are doing working interests that are just pumping oil, those news things really aren't going to be impactful. Same thing with real estate, right? Like my lease on my tenant isn't going to change whether this or that happens, right? Immediately. Yeah, sure, there could be like longer term effects or different nuances that are, coming down the pipeline, but those are then opportunities for me to pivot and navigate and do this thing called business. So in addition to, the tax benefits, cash flow, who can invest, and then how to invest. It's exciting to hear there's a number of opportunities, and certainly we'll have all those links and details that Michael mentioned, as well as opportunities to connect with us. If you're looking for opportunities that we're aware of that have the specific criteria that really just give things in layman terms, hey, this is a vertical well that's doing this. And, the investment is for sophisticated investors, right? That really gives you deal flow and the opportunity to say, hey, this year or maybe all years, I have a tax burden that I would like to offset, right? That opportunity to invest is powerful, and going with people who, you can like and trust. If you'd like to also hear more of Michael's voice, he did mention the deal, spotlight that him and Stu, go through, right, in more of the technical detail, as well as host an energy show. If you really want to get into the nuances of energy. But again, I want to specifically call out that investing in oil and gas does not need to be that you are an absolute expert in the energy or financial markets. Oftentimes, like we think we need to be within real estate. So if you continue to hear his voice in other platforms and places that he's at. Again, recognize that it's not a rabbit hole. Don't get sucked into it. If this is something that's beneficial for you, talk to your CPA, talk to your financial professional, and maybe that partner or significant other that you have if you are in that situation, and see how, when, and if you should take advantage of oil and gas for what we talked about today. So thanks for joining. Feel free to connect with us in a number of different fashions and reach out. Hey, one last thing before you go. I wanted to share my mission while on this earth, and it's to help educate investors about different opportunities, share mindset tips on how to change our perspective, and different things to really experience more joy in our lives. If this resonates with you at all and you enjoyed this episode, please share it with friends and others to help grow the community around the Investor's Guide to Joy. Leaving a 5-star review also helps grow the show and get connected to more people and share our experiences along the way. Thanks so much for joining, and can't wait for you to listen to the next episode.